the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Welcome back to the podcast, everybody. Episode 91 today. We are going to pick Chris's brain once again for his top 3 tax-free income strategies. So before we jump into it, let's take a brief moment as always and thank our episode sponsor.
This podcast is sponsored by The Mortgage Shop. Are you looking to qualify for an investment credit loan without jumping through hoops? That's easy. They have loans with LTV up to 89.99%. Exploring their products and discovering how they can work for you is simple. Just visit mortgage.shop or call 865-325-2566 and tell them TTF sent you.
All right, everybody, welcome back to the show. As always, let's dive off this thing like an Olympic swimmer, and let's look at those top 3 tax-free income strategies. That's the closest you're going to hear me get to a rapper, hip-hop artist, whatever you want to call me. But I brought him back. Chris Pacuro, welcome back, sir.
Thank you. Great to be back. Olympic trials kind of wrapping up and the Olympics pending. So I like your segue there, buddy. Like your segue. I'm excited about the Olympics this summer.
Oh, yeah. Hey, you know what? I can appreciate anybody who has that much skill in something that I do not. So let's talk taxes. Let's talk taxes. Let's keep it sexy and interesting. Let's keep it tax-free. So let's look at your top 3. And I know that you had a heck of a time trying to nail this down to 3 of them and not 33, which, by the way, is my lucky number. So what are they? Walk us through these things one at a time and explain to us why in the world you love these things so much.
One of the things to consider, and I mentioned this in our last episode, I mention it all the time, taxes are on sale under the Tax Cuts and Jobs Act. So what we have to think about is not just tax deferral, because a lot of tax planning is focused on tax deferral, immediately kick the ball down the road. I think everyone should be considering tax-free income and growth and have a bucket of their assets in tax-advantaged opportunities, accounts. Because I'll give you an example, John. Let's say you put money into an IRA today and you are in the 24% marginal tax bracket and you get a tax break. So you put $10,000 in, you get $2,400 extra in your pocket today. That $10,000 grows, and in 30 years, John, because you're so young, you take it out, right? Well, that $10,000 in 30 years could have very well grown to $70,000. I'm just making numbers up. What tax do you think you're going to pay on that $70,000 in 30 years?
Well, 0 would be ideal, but it'd be kind of high. I mean, let's put it this way, even saving that much money, having a daughter, maybe be able to afford an American Girl doll or something, because those things are as much as a house.
Well, John, let's put it this way. I can't tell you tax is going to be in 30 years because we don't know. So how many times would you go order from a menu without a price being on it? Not often. That scares the crap out of you.
Oh, yeah.
That almost as much as going into the American Girl store, John. John, I want to get personal for a minute here. And I love. Oh boy. When we were working together earlier this year, when you came down to gorgeous and historic Franklin, Tennessee, you had the fortitude to enter the American Girl doll store or American Girl store in Franklin, Tennessee. John, I've lived here 8 years. I've never been in there. Luckily, for some emotional support, you brought my wife with you, and you successfully purchased some things for your daughter at a very reasonable rate considering, including, I believe you got a dog, didn't you?
I did. And you know what the craziest thing about that is? So, and I'll connect this with, not knowing what the future holds. So I knew stuff was a little pricey. Okay. But if we're talking tools here, price is never an option, right? It's because you could die. If the blade comes off, you're in trouble. But basically what you were referring to is, ordering something off a menu, not knowing the price. It's kind of how I felt walking in there. And I know your wife, Holly, was just laughing her butt off. So she walked in first, and it was I would love to see the security cameras, because I basically stopped like right at the door. And I'm sure she could tell you all about this. I like refused to put 1 foot in. I almost wanted to do like window shopping and say, grab this, grab that, see how it goes. So yes, I made the mistake of walking in there. The only, blessing in disguise, they were closing in like 3 minutes. So I had to make a decision quick. But that stupid dog you're talking about. Yes, it was a little stuffed basset hound about half the size of my hand. That little stuffed animal was actually like 15% of what we actually bought our real basset hound for, which is crazy. So anyways, clearly I'm getting all heated up. It's almost like if I ask you, all these questions about, what is it, a contract employee or something? What was it? No, a 1099 employee. That's how I feel. Anyways, back to your regularly scheduled program.
Oh, Lord. Well, hey, you know what though, John? And I love Cooper. Neither dog could see either at this point.
Right. They're both blind. They both have non-functional equipment. But my gosh, yes. Anyways,
I've heard that might run in the family, John, but that's another story.
Hey,
all right, let's move on.
He gets it from his human mother. Let's put it that way. Ooh. That's why she married me.
Thank goodness no one listens to these. All right, in our family. But in all seriousness, so tax-free, it is so important to implement some tax-free income and growth strategies. And I would argue, even for people in a high marginal tax rate, to have something tax-free is more valuable. So if your tax rate's 40% between, let's throw California under the bus, we'll chuck you in there, right?
It's been a few episodes.
Federal.
We need to.
I know. If California, if your tax rate's 40% and you earn 5% interest from the bank, you're really only earning $3 of interest from the bank because 40% is going to your business partners. So if you can earn, you're better off earning 4% tax-free than 5% taxable. So let's talk about my top 3 strategies. We've talked about all of these strategies at some point on this podcast. We are now in the 90s. We are in the 90210 Beverly Hills.
Oh, okay.
Oh yeah, I know. Era of this podcast, and we're going to talk through it. So number 1, in no particular order, we don't want to make any of these strategies jealous, are 529 plans. We've had, again, a whole episode on 529 plans, but ultimately a 529 plan is an educational savings plan where people make contributions, the money grows tax deferred and is distributed tax-free if it's used for qualified educational expenses. In recent years, there's been much more flexibility as to what that money could be used for tax-free. It could be now used for K-12, not just college. So this isn't a college savings plan anymore. It's an educational savings plan. So K-12 tuition, it could be used for trade schools, and now it could actually, if you have money in the 529 plan that's been there for 15 years or more, you can now roll it, there are limitations, into a Roth IRA. So 529 plan is a really one of my top 3 tax-free income and growth strategies. Remember, the parent is typically the account owner, could be a grandparent, could be a rich uncle. If I have a rich uncle out there that's listening and I don't know about you, please contact my people immediately. And the child is the beneficiary. You can always change the beneficiary without triggering a taxable situation. So 529 plans is one of the 3.
And that too, Chris, you mentioned some with that too. I just want to highlight, right? So a 529 plan is being set up by the parent.
Typically, yes.
It's owned by the parent, and the beneficiary is, hypothetically speaking, the child who plans to attend higher ed, certifications, anything like that. So, but they can also move that, right? So say we'll just use a situation. Say we'll use a wild one because people know we like to do that. Say you have one kid, you set them up as the dependent, obviously you have one child. Naturally, that's who that be. This child decides that they want nothing to do with you when they turn 16, which I am terrified that my daughter will become that way. And she moves out with her boyfriend and you never talk to them again. And then you decide that it's a great idea in your 50s to adopt a child. So you can always switch the beneficiary.
Correct. John, I have a feeling your daughter will still like Stacy, though. Maybe not you.
Yeah, as long as there's one of us she likes, I think it'll be fine. So I'm definitely being the cool one. Stacy's the enforcer. So anytime she does something dumb, I just kind of like squeak out of the room and then wait for my wife to come in. It's a strategy, right? Like we talk about planning and strategy. It took me 3 years to figure out one that works.
Yeah,
with the child. So it's going good.
It works.
So let's talk another.
Number 2 out of 3. Number 2 of 3. Yes, Roth accounts. So Roth accounts, I'm using a vague term because a Roth could be 401k, could be an IRA, it could be a 403b, but it is typically going to be your IRA or 401k. A Roth is a retirement account, but unlike traditional IRAs or traditional 401ks, you do not receive a tax deduction when you make contributions to a Roth account. That being said, the money grows tax deferred and is distributed tax-free if you make a qualified distribution. So remember that example, John, I said you put in $10,000 into your retirement plan and you got a $2,400, $2,200 tax benefit.
Mm-hmm.
But then you were able to take that money grew to $70,000, right? Well, what if you put that money into a Roth account of some type? Well, if you put that money into some type of Roth account, you would forgo the $2,200 to $2,400 worth of benefit today. But when you take the $70,000 out down the road, that's all tax-free. So that $60,000 of growth is tax-free. Now, there are obviously limitations to Roth contributions, and there are multiple ways you can get money into a Roth account. One is a contribution through either a Roth IRA or an employer-sponsored plan, or you can convert money into a Roth. But that being said, there are some limitations as far as income on Roth IRA contributions. Before you listen to this podcast, give us a 5-star rating, share on social media, and sing from the rooftops. This is the best podcast you've ever heard. Thank goodness your financial future is secure. And then the next thing you do is go online and fund a Roth account. Make sure you talk to your financial advisor and your tax professional to ensure that you are making contributions that are allowed based on your marital status, employment status, and income.
Great advice. And question with that too, Chris. So is one of the limitations with the Roth account, is it if there is a, we'll call it a contribution limitation, like a monetary cap, if you will, is there any ways around that? Like, is that per account or is that basically per individual? So like if you had a cap with one, could you open another one? Can you do et cetera?
It is, right. It's typically, they're both. There's going to be a contribution limit per individual. And it depends if it's a Roth IRA or if it's an employer-sponsored Roth. Unfortunately, the Roth IRA accounts are also limited based on your income. If you are married, your spouse's income. If you have an employer-sponsored plan that covers you, or if your spouse does. For some reason, if you work for an employer that offers a 401k plan with a Roth component, which most of them do, you can make contributions to the Roth regardless of your income. The employer match has to come in as a tax-deferred contribution. Are there workarounds? Absolutely. I'll give you a great example, and then we can hit number 3. John, let's say your wife is a very successful dog groomer.
Oh, okay.
We know she's an animal lover.
Best around. It's a free subject.
She's self-employed. She has no employees. And you sit in your basement and play video games. Fortunately, she married down. You don't do anything. And you basically are a lazy bum. So you have no income. So she's making all this money and you take care of your pet fish. She makes $700,000 a year. She is an awesome dog groomer, huh? her income might be too high for her to really make Roth IRA contributions, or it might be limited based on her income to only $7,000 each for you and her. But since she's self-employed, she could always create a solo 401k plan with a Roth component and then contribute 3 to 4 times that amount without being concerned about the income limitation. So the point is, there are workarounds. I don't necessarily like to call them workarounds. There are planning opportunities. That's why it's important to understand your employment status, marital status, and income. That's going to drive what we want. What we want is people to come to us and say, as tax professionals, as teaching tax law community, I want to start growing my Roth dollars. Here's my situation. Here's the amount of money per year that our household's willing to commit to this strategy. Tell us the best way to do it. Because there are also things called backdoor Roth contributions. You're putting money, non-deductible contributions into an IRA and converting it to a Roth. If you're listening to this, be aware of the power of a Roth account and make sure you build what we call your board of directors so you have the people in place to help. If you're listening to this and you feel like you're on an island, you don't know where to go to get this advice, take a breath, and just join our Defeating Taxes private Facebook group. Shameless plug, defeatingtaxes.com. We will help and guide you. Doesn't cost you a dime.
And I know, Chris,
just don't go to TikTok and start hiring people off of that.
And on that point too, I mean, I've seen a handful of the people that have got a hold of you directly, right? And that's through your personal website, really. And people get a hold of you, right? I mean, maybe before we jump into that third one and kind of close out with that too, I wouldn't say use a scenario necessarily, right? But there's no harm, and this is, not just for you, I think for everybody in general, right? Planning is so important, and understanding it, not only what the situation is now, but what it is, projected to be the best we can in the near future and more long-term, right? So like we were talking about certain caps, like you gave that great example of kind of a loophole, if we will, legal and ethical way of doing things. Lots of opportunity for those that are self-employed. Lots, like an unimaginable amount of tax opportunities with that. But it really takes kind of the bird's eye view of everything that you have, what your current situation is. I mean, down to, I'm sure you've talked to people and you say, well, if you plan on starting a family in the next X number of years, you may not want to do something right now,
correct?
Which could, drastically change the way things happen, in 2 or 5 or 10 years. So maybe, I know these are 3 great examples for, that you use a lot.
Absolutely.
Is there one, but is there one that people just completely do? And I'm pulling this one out of thin air, so you're probably going to want to punch me for this one because you love when I do this. But is there maybe a strategy that people just totally misinterpret, misunderstand, that sometimes you have to tell them like, it is what it sounds like, but there's a lot more to it. And it may actually be the one that we're about to talk about in number 3, where people just don't understand it, but it's something that holds immense power.
This is going to sound like a cop-out answer. Almost every strategy is situationally dependent, a term we like to use. Strategies and ideas are cheap. Implementation is where the value is. So I'll give you examples. I just spoke with a client this week is going to have a $400,000 capital gain based on the sale of their primary residence. They listed it. They got an all-cash offer. And now it hit them. Oh my gosh, is this taxable? Guess what? They've only lived there a year and 10 months. If they sell their house, it's going to cost them about $100,000 of state and federal tax. If they hold on to the house for 2 more months and live there for 2 years, then they pay no tax. So the Section 121 exclusion is a great example. Now, there are some exceptions. So all of these things are powerful. But as guys, John, we guys in general, we get something, we rip the box open. Remember, again, a video game when you were a kid, you'd rip that box open, you'd grab your Nintendo controller or whatever, that PlayStation. You never read the directions. I'll figure out what A, B, and C do. So a lot of times we do that. And it's important to actually read the directions and make sure that you're making decisions with the understanding of the tax ramifications. We say teaching tax flow. Every decision has a tax burden or benefit. Tax flow and cash flow are different concepts. So a lot of times in the teaching tax flow community, we have people that just aren't experienced with tax planning. They'll say, I'm going to sell this rental property. My profit's $80,000. Okay. Is that what you're getting at closing? Yes. That's not your profit. That's actually just the cash you get at closing. Your profit's probably less because we have to look at what your cost basis is, your depreciation, your passive activity losses. There's a lot of other factors in that. So yes,
and honestly, I don't think that's a cop-out answer at all.
Oh, good.
To be honest there, buddy, I think that's actually a better answer than I expected from you, besides the punch in the throat for pulling that, which, again, as anybody that listens to this, we absolutely do not script these at all. The only thing that we come up with as an organization are, hey, what topics do we want to put on the schedule? And hey, if we have a great guest, let's bring them on. So like these are the most authentic conversations that I think we could have. The only difference is me and Chris could be at the bar talking about these. We could be on a plane together, or we could have a mic in front of us. And I mean, there might be a couple 4-letter words that we have to cut out of my mouth if we record it in public, but all things considered, it's the same conversation. And really, I mean, to toot your horn a little bit, and again, I do the editing on these, so I can say whatever I want, or I can edit it after the fact. But it really, like you mentioned that, I forgot exactly verbatim out of your mouth the way it came, but the strategies are cheap. However you word it, the pudding or the whatever is in the implementation, which it's the same thing, right?
Right.
Think about blueprints for a house. My mind obviously always goes to construction. Hiring an architect is way cheaper than it is to build the actual house. But, that being said, that's a given. When you're looking at a piece of paper as a plan, everything looks great. It looks fantastic. You're excited. You start to envision it. But then once you start framing, paint, decor, all this stuff, things change, time passes. You can make a lot of mistakes with that your house could fall down. Like if you completely forgot about, hey, you know what? I'm building this on the side of a cliff.
Yeah.
Maybe I should think about this. Your house is going to look great while it's being put together. You're excited. And then 4 years down the road and, you're 300 feet down in a canyon with no house. Again, crazy example. No,
you're kind of remind me, that house. Remember in Panama City Beach when the tornadoes hit this January, we saw a house. We might have to find that picture. It's literally 3 blocks from where teaching this podcast was born, and with the pizza box and that story was told. But a house fell into another house. It's still there because I was down there a few weeks ago for a baseball tournament, and it's an insurance disaster because the house literally fell on sideways into another house.
Crazy, but it's totally true. I mean, and you get, this is where the tooting your horn comes into place. Just the way that you and your team look at things. Right. And let's be clear, I'm not tooting my own horn here because I'm not part of the tax people team in the private practice world. And God help me, you don't want me on that team. I'm the marketing guy. But the way you guys look at things is very unique in a sense, and it's very comforting. And I wish more people could actually see that because, I think and this now I'll poke fun at the marketing guys in the world. And, of course, they're going to hate me for this is, we're very good at putting a spin on things to make it seem easy, but easy is not always the best, right? So there's no cookie cutter. And I've seen you work on tax returns and planning. You're just not keystroking away, putting numbers in and hoping for the best, right? Like we talk about AI and taxes, and is that going to replace the need for tax professionals and CPAs? Absolutely not. I mean, I think everybody's in agreement of that is, it can look at things at a certain point of view, but it cannot, even if it asked you all the qualifying questions in the world, it still could not give you the output of somebody that's been doing this for 20-something years like yourself and y'all's team. And just the way that you guys package things together and plan for things.
Right.
And again, kind of, putting different strategies together. So we won't talk about compounding them or anything like that yet. But the next one I know we're going to get into, your number 3 here. There is a lot of buzz around this, and there has been, especially in the real estate investing world. I've seen it a ton. So I'm excited for you to walk us through this one, and I will not steal your thunder and tell people.
No, that's all right. And I want to, as we wrap up with the third one, I want to point out, you made a great point. Strategies should be used in tandem. It's not or, it's a with. So there are a lot of different tax strategies that complement each other. And the three we're talking about today are just my three favorite. Gold diagnosis, tax-free income and growth, is my favorite color-coded diagnosis out of the four in teaching tax flow. So the third favorite is it has a couple different names. I call it advanced whole life insurance planning. I use it myself. Some people call it infinite banking. There's a lot of different terms for this, but ultimately, it's utilizing a whole life insurance policy that has a cash value to utilize some of your premiums that you're paying to build the cash value. That cash value can grow tax deferred over time, and it could be distributed tax-free and allow you to have a lot of liquidity. That distribution could be a distribution or a return of premium. It could be a loan. Yeah, this isn't something that you just go off and do on your own, go on one of those websites and get your own whole life insurance policy. This is something that you work with a financial professional that's on your team to discuss. There are rules as far as there are limitations that you have to consider, so you avoid MEC, which is a modified endowment contract. But this is something the younger you are, the better before you implement this. Unfortunately, to be real transparent, I waited till my mid-40s to start implementing this. And luckily, I was healthy and I was able to get insured and everything's great. But it's something that you want to work with. And this is especially important in your younger years because you don't have the amount of assets you're going to have when you're older. Hopefully you grow your assets, but you want that life insurance protection, that disability insurance protection, but also have something that's building a war chest for you. So advanced whole life insurance planning or infinite banking is my third. And again, if you're looking for help, please let us know. John, I spend a lot of time personally vetting professionals and making sure that the people in our teaching tax flow community and our private CPA practice are in great hands.
Absolutely. And then, Chris, again, too, just to add to the fact of that, why this is a very unique conversation that I'm seeing as, right? It's, although this is a tax-related conversation, you do bring a very unique perspective to this because you personally are a certified financial planner. So, like that being said, it's not just, oh, this is only tax, because some people look at it as, oh, well, my accountant, my CPA, all they do is look back. They never plan forward, where you're kind of in the middle. You're basically an owl, right? I'm going to start calling you the owl, the tax owl. There we go. Because your head spins around so quick, forward to back. Well, it's not like you're playing pickleball, though, too, which, by the way, I did mention pickleball.
Oh, we haven't talked pickleball in a few episodes. Oh.
We didn't mention it last episode either, I believe. So there you go. I take the trophy. I'll put it back on my shelf. But I think the perspective of this, we talk about blending strategies or compounding strategies, over time. This is blending them from the financial planning side, also bringing in the tax side. So a lot of these, we talk about, one of them is not the answer to all your world's problems. Multiple make life a whole heck of a lot better and secure. So that being said, again, as Chris, you had mentioned too, and, legally, I think we have to put the disclaimers in here, but we do it anyways, just because we look out for people. But definitely contact, those in your life that you work with, or if you're looking for somebody, because I know you mentioned too, just get a hold of us. We're happy to make connections, to who may be the best fit for you. So it's the ball is in your court as the taxpayer, as the individual. You really can't rely on somebody else to take the first step for you. You really got to do it yourself. But just building your personal board of directors is now more important than ever because, as we mentioned in last episode, just tax only, 100 plus years ago, I think the tax book then was 400 pages, and now the tax publication is 70,000. So unless you have a lot of free time and you really enjoy it, you're never going to know all that. Heck, most CPAs don't know all that. They just know where to look to get the answers. So that being said, we're going to shut up. Ball's in your court. Game on. We will see you back here next week on the Teaching Tax Flow podcast.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.